Hello and welcome. This is Ramesh Nyberg, CEO and founder of Property Solutions of North America, and this is an introduction to note investing. We're very glad you're here, and we hope that this will help you along your journey to understanding what the note business is about, what a note is, and we're going to cover all these things in just a few moments. Before we go on, I think it's important to cover a couple of basics. And I'll start with a quote from Nelson Rockefeller. The secret to success is to own nothing but control everything. In the note business, you don't own the real estate. At least you don't start out owning the real estate. You own the debt, but you control the real estate. You control the debt, and you actually manage the borrower. We'll talk about that later, but that's a very appropriate quote for this industry. And I think we can all agree that Mr. Rockefeller knew a few things about money. It's important for you to understand that our company is not a real estate broker. We're not financial advisors, and we're not attorneys. Nothing in this video should be construed as legal advice or financial advice. If you have any questions regarding the legal aspect of anything in this video, the legalities in your state or your particular situation, you should consult an attorney. Let's start with what a note is. And if you're unfamiliar with it, it's very simple. A note is something that is part of a loan agreement when there's a purchase of real estate. Now, unless this real estate transaction is a cash transaction, there's going to be a loan, as most people don't walk around with lots of cash and they usually need to borrow some money. So they borrow money from a lender, and that lender has to be assured that the money is repaid. They do that by this agreement called a loan, mortgage, and a note. So there's two parts to this. The mortgage is a description in legal terms of what the property is. So there's no ambiguity about where the property exists and what the address is, what the legal description is. The note part is an IOU. The note part says, you guys borrowed X amount of dollars from us, the lender, to buy this house, and you have to repay it. So the note says exactly how much is to be repaid, under what terms, how many months, what the interest rate is, where the payments are to be sent, all those things, so that's very clear to the borrower how they have to repay the loan. The mortgage also serves as a what if, and that what if is, hey, for whatever reason, if you cannot repay this loan, we get to take the property. So the reason why the mortgage is very explicit about where the property is and what the legal description is that the lender can take the property away if the borrower does not fulfill their end of the promise to repay the loan. So a note is pretty much an IOU. Why would people sell notes? Well, let's start out with who sells them. The bank holds notes. Banks across the nation hold millions of notes, and we also have individuals. So there are people that write notes when they're seller financers. So if they're selling their home and they decide they want to carry the note themselves instead of have the borrower go through a bank transaction or a bank loan application, a lot of individuals will hold notes. And a lot of times they get tired of doing that, and they may want to cash out. They may want to get more cash out of the transaction that they didn't get in the beginning. So a lot of notes that come into the market are from seller financers. Usually these are performing notes, and we'll talk about what a performing and non-performing note is in just a moment. Banks will sell mostly non-performing notes, and they might sell them in bulk, as we've seen in these type of stories, where in March of 2018, Fannie Mae sold $2 billion worth of reperforming loans to a private equity firm. So that gives you a glimpse of how big this industry is. Several months later, they sold almost $2 billion more in non-performing loans to a Goldman Sachs subsidiary. So there's a lot of money and a lot of inventory moving in this marketplace. So the two types of notes that we've been tossing around, these names and these phrases, performing and non-performing, is pretty simple. A performing note is one in which the borrower is on time and has been paying their monthly mortgage payments just like they're supposed to, just like the note says they are going to. These are a little more expensive than non-performing notes. There's less risk involved. These are perfect for the passive investor who simply wants to get in on a good yield, and these yields can range from 5 to 6% all the way up to 13 and 14% in some situations. There's less of a discount, but they are sold at a discount. Non-performing notes, in which the borrower is behind or they're always playing catch up, this is the type of thing that the banks will want to get off their books because it doesn't serve them well to have them on their books. And in fact, they can be sanctioned by the federal government if they have too many of them on their books. These are riskier to deal with. There's more work involved. If you buy a non-performing note, you have to be ready to work with the borrower and try and rejuvenate them. In a way, this can be very profitable. So you can actually get a non-performing borrower to perform again, maybe by modifying their loan. Remember, you're the bank, you're the lender. Now that you have purchased this note, you're in charge of managing this borrower. So you have the freedom to structure a loan modification however you want. In some instances, you might get this person back performing again. Now you've taken a non-performing note that you got at a deep discount, maybe 55 cents or 65 cents on the dollar, and you can sell it for higher than that because it's now a performing note. So in essence, you have done a fix and flip, except it's not on a house, it's on a borrower. All right, you've rehabbed the borrower. So those are the two types of notes that we see in the marketplace. And they're both secured by the real estate. And we'll talk about that in a minute when we talk about exit strategies. So if you do have a borrower that's got empty pockets for whatever reason, they've fallen on some hard times, maybe one of the married couple has lost a job or, God forbid, passed away, and the other person just cannot make ends meet. So how do you deal with that? Well, you can sell the note, or you can try and work out a loan modification as described before. You can also offer them what's called a deed in lieu of foreclosure. And this is something that's very appealing to a lot of borrowers who have run into trouble. And the reason it's appealing is because it allows them to walk away from the loan with a satisfaction of mortgage and no negativity on their credit history. In fact, it can actually enhance their credit history because they have a satisfaction of mortgage. And what happens is they literally sign the house over to you, the lender, rather than you go through the foreclosure process. And of course, the last option is foreclosure. This can vary from state to state. So whether a note, is in Maryland or Texas or Florida, all states have different rules. Some states are a lot easier to foreclose on a property on, and some are more difficult. And that can also affect the price of the note on the market, as you'll see going forward. Once you foreclose, or once you get a deed in lieu, you own the property. It's yours. It's deeded in your name or your company's name, and you can sell that property, rent that property, do whatever you wish with it. Here are some things that might show up when someone sends you information about a note, and most often you'll get even more information than shown here. You'll get the address, you'll get the state, you'll get something called a BPO, which is an important number because a BPO will tell you how much the property is worth on the market. BPO stands for Broker's Price Opinion. That means a broker or a realtor did an assessment of this property, did their CMAs, and came out with this number and said, this is what this property can sell for. And the reason that's important is you don't ever want your unpaid balance to be more than your BPO, because if you end up having to foreclose, you're going to end up losing money. So you want a nice spread between the UPB and the BPO, and we'll talk about what that is in just a minute. You'll also see the rate of the note. That's the interest rate that you're receiving, and the payment, and the amount of months you can expect to get that payment of $346.01 for 88 months or whatever is left on the loan. So again, the relationship between the unpaid balance and the broker's price opinion is called a loan to value. Let's take a look at an example to put this into kind of a real life situation. Here's the scenario. So you have a note that has a $27,000 unpaid balance. The borrower has been paying 9.5% interest, $227.03 a month, and the value of the property has been assessed at $55,000. So remember we spoke about the loan to value, and it looks like we got a pretty decent loan to value there. There's a nice spread there. You're able to purchase it, let's say, for $22,000. This is a performing note. You've basically bought $27,000 worth of debt for $22,000. And let's say that all of a sudden this note becomes non-performing after some time. Maybe the borrower runs into problems, loses a job, any one of the many scenarios that could happen. Let's look at the different things that we can do. So you can try and work out a loan modification. Let's say, and these are just fictional numbers, you can work out whatever you want with the borrower as long as it's amenable to both of you. You're the lender, so if they have some cash they can put down, maybe it's $3,000, maybe it's less or more, whatever. Now you've reduced their balance a little bit, and maybe you can reduce their interest. You got a new monthly payment of $177.59. It's $50 less, and with some people in some properties that can be a lot. That can make a big difference in their lives. Maybe you can keep them in their home. And that's one of the rewarding things about this business, is being able to save people from foreclosure and kind of be the hero here, and everybody wins. Well, let's say that doesn't work. Let's go to scenario number 2, and you might have to go the deed in lieu of foreclosure route. If they are able to accept that, then of course you acquire the property. Maybe you want to sell it, maybe you want to rent it, but if you sell it at market value, looks like you have made a $33,000 profit, right? You purchased it for $22,000, you're selling it for $55,000. That's not too bad a deal. And the borrower gets to take a walk without a credit hit and gets a satisfaction of mortgage. If you have to go the final route, which none of us really want to do, but it can happen, you might end up having to foreclose. Your costs to foreclose, they can range pretty widely. And again, we talked about different states. If you have a state that has a long drawn out process, it could cost you a few $1,000s for lawyers' fees. But either way, you acquire the property, again, sell it at market value, and minus whatever expenses you had to foreclose on the property, you're still going to make a pretty decent profit on that situation. So that's how a note transaction could evolve if it went from performing to non-performing and you had to use one of these different exit strategies. Here's something that you may want to pick up even if you're a passive investor. If you like to be in the know and have a little more hands-on about these transactions and how these mortgages are amortized, and how the numbers play out, you might want to get one of these, the HP 10B2 calculator. It's a financial calculator that you can teach yourself to use in a matter of minutes. I found it very useful, and I would highly suggest you have one, unless you just want to put your trust in all the numbers that people are telling you. It's a good thing to buy. I think they're about $35 or so, or maybe even less. Also, this book, it's called Invest in Debt by a guy named Jimmy Napier. Absolutely fantastic book. It's not very long. Invest in Debt, the how-to book on buying paper for cash flow. And Jimmy Napier really does a great job of explaining the principles of investing in debt and why it's such a great idea. He also will fall back on his HP calculator, so if you've bought one before you read this book, you'll get an awful lot out of it. All right, let's summarize what we've been talking about. The note business is low risk and low liability. You don't own the real estate, you own the debt. You don't have to deal with tenants and toilets like a landlord does. You can be a lien lord instead of a landlord. It's a lot less headache involved. Just like Rockefeller's quote that we showed you in the beginning, own nothing, control everything. You can create passive income for yourself. These notes vary from 12 months, 18 months to 360 months. So this is something that you can do for the rest of your life. You can do it from anywhere in the United States, and you can invest in notes that are initiated anywhere in the United States. Your investments are secured by real estate. So in the very worst case scenarios, you acquire the property and then you can do what you wish with the property. We urge you to get as much education as you possibly can. There's a lot of sources of information out there that you can tap into, and we of course invite you back to learn from us, and we can learn from you as well. Our contact information is at the bottom left of the screen. Give us a call, send us an email at info@nodeconnections.us. We look forward to hearing from you and working with you, and we wish you the very, very best in all of your investment ventures. Thanks for listening.